if you're halfway through your studies, because it's never too late to go back and just make sure that knowledge is there. Throughout the week, we've got sessions running Tuesday, Wednesday and Thursday, and we've got activities going on in terms of cash books and bank reconciliations. We're going to have a look at balancing off ledger accounts. We're going to have a look at trial balances, and then we're going to conclude the week with journals, errors and suspense, and what happens when it all goes horribly wrong. So I hope you'll take a lot away from the week. I have got a colleague with me this evening to keep an eye on the chat. So between the two of us, we'll do our very best to answer all your queries and make sure that you go away with every question answered. What I would say, guys, is my contact details are at the very back end of the PowerPoint. So please don't hesitate to get in touch. I know you've all got your individual tutors, and obviously, of course, they're your first port of contact. But if there's anything that crops up from tonight's session, my contact information is available. As you know, for those of you that have done these sessions before, or if you're brand new to us, just to let you know, the sessions are recorded. So what will happen is at the end of the week, so not at the end of each session, but at the end of the week, you'll get a link to the various sessions that take place. And that enables you at your own leisure to go back, pause the video, stop, replay, whatever particular part that you need additional support on. So without further ado, let's get cracking. Tonight, we're going to have a look at business transactions. As I said, back to basics. Do we understand what a business does and how the transactions are recorded? Once we've established that, as the accountant or the bookkeeper of the business, what's the financial implication of that transaction? How will that be recorded? How will that impact the business's accounts? And we're going to have a look at some double entry. We're going to have a go at some activities. We're going to focus on cash, credit, sales and purchases. So we need to be clear of the difference between a cash and a credit transaction, and we'll look at that. So hopefully that's the aim. Within the next 60 minutes or so, that's my objective, to help you with that. Businesses engage in a variety of transactions on a daily basis, and you can relate to that. I mean, some of you may be employed. If you're not currently employed, think about perhaps your local supermarket that you do your weekly shop with. Think about the holiday that you utilise, the shop that you utilise to get your holiday clothes maybe. But businesses, no matter what industry, no matter what scale, no matter what size, will engage in some fairly repetitive transactions, hopefully. And they will be cash and credit sales and cash and credit purchases. Now, guys, I'm not going to apologise for the number of times I reiterate this point, because it's really important. But whenever we talk about a cash transaction, a cash sale or a cash purchase, I don't physically mean notes and coins. All I mean is that the payment happened instantly. So there is no future obligation with that business. What you will find is that some businesses trade on credit, and we're all familiar with that, where we buy now and we pay later. But from a business point of view, whether it's a cash transaction or a credit transaction, it needs to be captured and needs to be recorded. What about if the business needs to acquire some non-current assets, so some vehicles, plant and machinery, buildings, premises? Again, that needs to be recorded in the accounts of the business. And just daily operating expenses, so your utility, your insurance, your rent, your rates, all these are transactions that a business will encounter, some daily, some monthly, some maybe annually. But as the bookkeeper, or as the accountant of the business, it's your job to record them accurately in the accounting records of the business. And that's important, guys, because the accounts of the business helps us monitor the performance of that business. Is it going in the right direction? Do we need to reduce expenses? Do we need to do a promotion to increase sales? So the accuracy of what we do is of paramount importance. So I'm going to make this sound really simple, but all we've got to do this evening is feel comfortable with the double entry for those types of activities. As I said, I'm going to make it sound simple, but it really isn't. Before we can kind of look at debits, credits, recording the transactions, we need to understand that the accounting equation, and I'm sure that's something that you've come across and if you've made a start on your studies, But we need to understand that the accounting equation lies at the heart of everything we do in terms of double entry. And in its traditional form, it will be recognised as assets less liabilities equals capital. Otherwise put, everything we own less everything we owe equals the capital that's been invested in the business, the investment made by the owner. But that's an equation, and like any formula, it can be rearranged. So sometimes you may see it expressed as liabilities plus your capital equals your assets. We need to understand the accounting equation because as you come across various questions, sometimes you'll be posed with a scenario which talks about sales, which talks about purchases, and asks about the impact on that equation. So we need to be comfortable with that. And hopefully at the end of this session, you'll have a good understanding of those three items. The accounting equation is at the heart of what we do. So whenever we're talking about we're debiting one account, we're crediting another account, we're basing it on this accounting equation. But to be comfortable with the accounting equation, we need to be comfortable with the three elements. So an asset is something that a business owns, and generally that's available for use within the business. But what we need to be clear on is that there is two categories of assets, and we can categorize those into what we call a non-current asset. And a non-current asset is something that the business owns and generally retains for longer than 12 months. So things like plant and machinery, fixtures and fittings, computer equipment, motor vehicles, sizable items, expensive items that generally will be around for a longer period of time that will help that business function. But we also have things called current assets. Current assets, again, if you're doing any type of reading, you may hear that referred to as a liquid asset or a liquid resource. And the idea behind that, guys, is it either is cash or it will generate cash. So examples of those could be things like your cash in your bank balance. Well, that is a current asset in its purest form because it's liquid cash. But things like your inventory, if you sell your stock, it will generate you cash. Things like your receivables. So your receivables, that's a fancy term for saying your credit customers, basically. Again, if we're proactive with our collection of debts, we'll collect our money from our customers and we'll get cash. So assets, something that the business owns and can be split into current, non-current. And that general distinction is that 12-month rule and the fact your current assets are your liquid resources. They either are or they will generate cash. Liabilities, this is something we owe. So this is money that we owe to different parties. And just like assets, they can be classified into current and non-current. So things like non-current liabilities would be perhaps a loan. So if you took a 7-year loan out, it does get a little bit complicated, but if you took a 7-year loan out, that loan would be classed as a non-current liability. As you progress through your studies, what you'll find is that 6 months of the loan becomes, 6 years of the loan becomes non-current and 1 year becomes current. But for now, let's just say it's a 7-year loan and a 7-year loan and it's all non-current. Current liabilities, just like non-current liabilities, is something that we owe, but for a shorter period of time, and they fall due within 12 months. So examples of this could be what you owe HMRC. The VAT man's certainly not going to wait 12 months or more for his funds. Payables, your credit suppliers, again, they're not going to wait 12 months. So generally 30, 45 days maximum. And the other one there that could possibly be that we come across frequently, maybe a bank overdraft. So if we owe the bank, that would be classed as a current liability. Now, I know some of you could be sat there thinking, well, you could have an overdraft for longer than 12 months, and you could. What I would say to you is generally, if there's a forecast, a projection that you're going to need surplus funds for over a 12-month period, you're going to need additional funds, then it perhaps may be more competitive to look at a loan because the rates may be slightly better for you. But that's just a general point there. And then capital. Well, this is the amount invested by the owner into the business, and ultimately it's what the business owes back to the owner. And there's a slight confusion there because when we talk about capital, we instantly think cash. It's a cash investment made by the owner, and generally, guys, it is. However, It could also be any personal assets that the owner introduces into the business for business use. So, for example, if you were setting up your own business and you got a laptop, you didn't really use it for personal use, and it was going to be used solely for business use, that will be classed as an asset of the business, and that will be classed, the value of that laptop will be classed as a capital investment. Okay. So assets, liabilities, and capital. Are we all okay? Are you all with me? You're still awake? Everyone okay? Fab. Brilliant. Thank you ever so much for acknowledging that, guys. Fabulous. Okay. So it's Monday, and you're going to have to use your imagination when I make this next comment. But I thought we'd have a little bit of fun. Now, again, stretch of the imagination, because it is a Monday evening and we are talking about double entry, but we'll go have a go. So I've got 9 items there. And what I'd like us to do in the chat together is I'd like us to work through them and see if we can establish whether we think they're assets, whether we think they're liabilities, or whether we think it's capital. If we're feeling really brave, we could say whether it's a current or non-current asset or a liability, but there's no pressure. What I would say, guys, is please don't think, or please don't worry if you get something wrong, because 9 times out of 10, when we get things wrong, that's when we learn. Okay, so please don't worry. That's what we're here for. We're here to support each other. So I'm going to start with cash, and I'm going to ask you now to type in the chat whether you think that's an asset, a liability, or a capital. Fabulous. That's amazing. Well done. And we've even got people saying that they think it's a current asset, and it certainly is, guys. Well done. Yeah, cash is a pure asset. It's a liquid asset in there in its purest form. Well done. Fabulous. We're going to work across. So let's consider now the balance owed to the payable. The balance owed to the payable. Fabulous. Excellent. Yeah, guys, this is excellent. And we've even got people saying it's a current liability. It certainly is, absolutely, because our suppliers, they're not going to wait longer than 12 months for our funds. Well done, guys. Thank you. Moving on to the next one, our motor vehicle. What are we thinking about that one, guys? Fab. Excellent. Well done. Everyone's got asset. And we've got people again saying it's a non-current asset. Well done. Perfect. It certainly is. Generally, a motor vehicle is going to be something that the business retains longer than 12 months, helps us do our job. So let's go back now to that receivable balance. What do we think? Receivable balance is another way of saying credit customer. Perfect. There's certainly no fooling you guys, is that? That's amazing. Well done. Spot on, guys. It is an asset. It's a current asset, because hopefully our customers will pay us within their terms, which will generally be 30 days, depending upon their credit scores. So what about an overdrawn bank balance then? An overdrawn bank balance. Spot on. That's great, guys. Current liability, you're telling me it is. It certainly is. Yeah, it's money that we owe to the bank. There's no problem having an overdraft, as long as generally the banks like us to be in control. They like us that to be projected. They like it to be forecast and arranged. So yeah, well done. Perfect. The next one, the money invested by the owner in the business. Fab. Lovely. Great stuff. We're pretty consistent there, guys. Everyone's in agreement. It's a capital transaction. It certainly is. It's money that the owners invest in the business ultimately the business owes it back to the owner, but it's that investment to kickstart that business off. Well done. Inventory is a bit of a peculiar one. What's your thoughts on that? Amazing. Fabulous. So we've got assets. We've got people saying current assets. Spot on. It definitely is a current asset. Tell me you're thinking possibly behind a current liability. But generally we would class our inventory as an asset because we've got it to sell. Once we sell it, once we collect our money from our receivables, we will then generate as cash. Oh, so you're talking about slow moving inventory? Yeah, we probably wouldn't classify it as a liability. So further on in your studies, there's various rules and regulations that we talk about, and there's with financial accounting, there's lots of regulations, there's lots of rules that tell us exactly how we treat different things. Inventory is one of those. So if we're in a situation where we have got slow moving inventory, perhaps its value has reduced, we would have to value it to what we call the lower of cost in NRV. So it may be that we're selling it actually at a loss, but that's the way it would be. But we would still classify it as an asset in essence, because it will generate us cash, albeit not necessarily the cash that we actually wanted for it. Obviously, there's different scenarios to that, and I'm happy to have a conversation, if you want to outside of this. But I hope that kind of answers your question. I hope it does. That's perfect, thank you. So owners introduce their own computer into the business. That's a really odd one. Well, it is odd, but you've all got it right. Fabulous. Yeah, it's capital. Okay, so it would be the value of that computer would be the amount of the capital that's been invested. So spot on, guys. Well done. There's no fooling you this evening, is there? And last but not least, what about our premises? I'm going to go owned. We own them. Excellent. And again, we're all consistent there, guys. We've all said assets. We've all said non-current assets as well. Fabulous. So it was fun-ish, yes. Or maybe not, but we got it right. So that either means you've done your homework or I explained it really well. I'm going to say that I explained it really well, but probably the reality is you've already done some reading on this, so you're already ahead of me. But well done, guys. Yeah, that's amazing. So we know what an asset is, we know what a liability is, and we know what capital is. So all our job is, I'm going to make it sound easy again, but all our job is to record the sales, the purchases, the expenses, the buying of assets, and put that into the accounting records of the business. To do that and to do it accurately, we have to have a really good understanding of the world of debits and credits. And I cannot impress upon you guys enough how difficult that is initially. So if you're part of the way through your studies, you may start to be getting a handle on this now. But if you've just started, maybe you've only had your books very recently, you've just started to do some reading, and if you're not from an accounting background, then probably the only exposure you've had to debits and credits may be your bank statement. And let's be brutally honest, the way it works on your bank statement and the way it works when we do it, dealing with it from an accountancy point of view, feels completely backwards and completely opposite. And that's okay if it feels like that, because it should feel like that. And as the week progresses, hopefully our sessions will unpick why it feels like that for you. This takes time. And guys, you know how this works. You've all got an individual timetable. That timetable, I want to tell you, is a guide. It's there not to put pressure on you. It's there just to give you some structure. But debits and credits is quite complex. So if you need to take an extra week, an extra 10 days, however long to get your head around this, it is far better to do that than to try and rush and not fully have grasped this concept. That said, prior to my current role, I used to work in an FE college. So we would start our courses in September, running through to June, and it would be face-to-face delivery. And I would teach learners starting in September, and it would be possibly November, December before they would start to have that light bulb moment and debits, the world of debits and credits clicked with them. So I'm trying to impress upon you, please don't worry if you're reading it and you read it and then you read it again and it still doesn't make sense. It will. It's just time. It's just time and asking lots of questions, and that's what we're here for, to help. So we're going to make this easy-ish. We talk about debits and credits. Ultimately, we're talking about double entry. Okay. So tonight, after I finish work, I'm going to go and get some petrol. Now, from my perspective, I'm going to fill my car. And I know I'm stretching your imagination with when I say £20, but go with me. I'm going to fill my car with £20 worth of petrol. So from my point of view, I've gained petrol, but I've lost £20. So if I was doing my own accounts, all I have to do, and I know I'm making it sound easy, but all I've got to do is record the fact I've gained petrol, but I've lost cash. I'm going to pop to Sainsbury's because it's 5 minutes away. So from Sainsbury's point of view, all they've got to do, their accountant, their bookkeeper, has got to record the fact that their inventory of petrol has reduced, but their asset of bank has gone up. So they've lost stock, but they've gained cash. And that's all we have to do. So when we talk about debits and credits, we're talking about double entry. And when we're talking about double entry, we're saying that every transaction has two effects. And all we have to do is record those two effects. That's all we've got to do. Each account has a debit and each account has a credit. Now, guys, what you'll find is that there'll be lots and lots and lots of ledger accounts. And on the left-hand side, you'll have your debit entry. And on your right-hand side, you have your credit entry. And if you're doing any reading, guys, you may have heard this referred to previously as a T account because it kind of looks like a T. But all we're saying is that for every transaction, there'll be a debit in one account and a credit in another account. Now, I've worked in finance in both public and private sectors. I've worked in education now for quite some years. And I've had it said to me a lot of times, why do we need this? Why do we need ledger accounts? Because when I enter an invoice onto my accounting system, I don't see one of these. And when I enter a payment, I don't see one of these. And that's a fair point. But I just want to take a step back from that. So double entry in that instance still happens. When somebody enters an invoice onto a system, the system is programmed so it knows what accounts to debit and what accounts to credit. When a payment comes in, so a receipt comes in, or we make a payment, again, the system is programmed by the type of transaction you do to do the relevant debit and credit. What I would say to you is if you're a small business, you won't necessarily have the funds initially to have an accounting software system. So you are going to have to deal with ledger accounts. You are going to have these ledger accounts. Also, what I would say is as your career progresses, you probably won't be responsible for invoice entry or credit note entry or making and receiving payments. You'll be responsible for preparing the financial statements of the business. And it's at that point, guys, when things go wrong, when things haven't happened as they should, that you will need to get involved. But guys, how can you correct things when you don't understand what happened in the first place? So it may feel frustrating because you can't always see this happen in practice. It does happen. It's just behind the scenes. But it's crucial that you have the fundamental knowledge of it so that when your career progresses, you're able to unpick things, you're able to put things right, and you understand what the numbers mean. So we talk about double entry. So all I'm saying is that for every debit, there is an equal and opposite credit. And mathematically, debits and credits have to agree. I like to think of double entry as a set of old-fashioned weighing scales. So for me, whenever I do double entry, whenever I do a debit and a credit, I picture that and I make sure my scales are perfectly aligned. Because if my debits are higher than my credits or vice versa, I have wonky scales. And if I've got wonky scales, I've got a problem. Okay, so think of your scales. They've got to be aligned when you do your transactions. That's the easy bit. We can all recite that, but knowing what's a debit and what's a credit, that's a skill. So hopefully what I'm going to do is I'm going to share with you a couple of strategies that may help. So PEARLS is an acronym that is commonly used in accounts. I have to say, I use this. I find this quite a nice, easy one. And what PEARLS does, again, debits on the left, credits on the right, is it says that if you're a purchase, an expense, or an asset, you have a debit balance. And if you're a revenue, a liability, or a sale, you have a credit balance. Personally, I do like PEARLS. But what I will say is this isn't one size fits all. There are certain transactions that don't nicely fit into PEARLS. So we could use dead click. And that's another common one that's used. And again, debits are still on the left, credits are on the right. And we have expenses, assets, and drawings, and they're all debit balances. Now, drawings is a new term. And again, if you're just starting your studies, that may be something you're not comfortable with. So we've talked about capital this evening, and we know that capital is the investment the owner makes in the business. Well, drawings are when the owner takes cash or goods out of the business for their own personal use. So in effect, drawings are a reduction to capital because it reduces what the capital invested in the business. So it's when the owner takes goods or cash out, but for their own personal use. On the credit side of dead click, we've got liabilities, we've got income, we've got capital. So, some people like PEARLS, some people like dead click, some people like a combination of both. It doesn't really matter, guys, as long as at the end of this process, we're comfortable with what accounts are debit balances and what accounts are credit balances. Some learners don't like acronyms. Yeah, they like rules. Okay, so we could look at rules and we can say that debits are still on the left, credits are on the right. When we're looking at these, what we're looking at is the fact that the opposite of a transaction will increase or reduce it. So let's think about that. So we know from PEARLS and dead click that our bank balance will be generally an asset. If we've got money in the bank, so it will be an asset because it's something we own. The money paid into the business bank account will be an asset because it will increase the asset. Money paid out will be a credit because it will reduce the asset. It's a different way of thinking about it. We know that when we make an investment in the business, it's a capital transaction. And we know that capital, according to dead click, is a credit. According to dead click, debits are the drawings. And that makes sense because drawings reduce capital because the owner's taking goods, cash out of the business. So it's kind of like the opposite. If we purchase a non-current asset, we'll debit the asset account because according to PEARLS and dead click, assets are debits. What about though, if we were talking about assets this evening, we said that a receivable was an asset and a receivable is a customer that owes us money. So if we sell more to our receivable, we will debit the asset account. We will debit the receivables account because they owe us more. What about when they pay us? When they pay us, it will reduce what they owe us, and therefore we will credit the asset account to reduce the value of the asset. The same is true for liabilities, guys. We know through PEARLS and dead click that a liability will have a credit balance. So think about perhaps what we owe HMRC. If we owe them more, we will credit the VAT account, credit HMRC's account to recognise the fact that we have a liability. But once we've paid them, we'll debit the the liability account to reduce the liability. So this is just thinking about things in a slightly different way. And an item of expenditure. So when we pay for, I don't know, our gas, our rent, our rates, our insurance, it will be a debit because both Pearls and DebClick say it's expenses are debits. Excuse me, guys. But when we make a sale, that's an item of income, and therefore that will be a credit. Again, I'm not sitting here and saying use Pearls, use DebClick, or use the rules, because, guys, it will change. Depends on what type of learner you are. Sometimes, people will only use Pearls. Sometimes I've known learners use all three. What I would say is if you are starting out and you're really struggling to get your head around debits and credits, then have all three methods on a post-it note just by the side of you when you're doing your activities, and you'll find that one will fit you better. And then that's the one that you could choose. That said, if you're using all three, as long as you get the right answer, it really doesn't matter. Okay. So I hope those tools will help. You're not going to feel comfortable with them initially. It's not something that you're instantly going to go away thinking, I've got this, but it will help over time. Again, let's have a go at some transactions, because I think if we put it into practice, it will help us when we talk through how we approach a question. So Andrew has started his own business called Bradley Enterprises, and he has the following transactions. He's made an investment into his business. He's purchased some stock. He's made some sales. He's paid some expenses. And he's made some more sales. So here I am again. I'm going to make it sound so easy. All we've got to do is we've got to do the double entry for those transactions. And what we'll do as we do it, we'll try and talk it through in terms of Pearls, DebClick, our rules, to see if it helps, that with your approach. Andrew placed £2,000 into his business bank account. So we've got two complications now. We've got to record the debit and the credit for that transaction. But we've also got to decide the names of the accounts that we use. Now, that's hard. And I'm going to sound probably really patronising when I say this, but the answer is in the question. It really is. So it doesn't matter if we're not sure, but any ideas of the two accounts I would use, just the names of the accounts. Please don't worry if you get it wrong. It really doesn't matter. But any ideas of the names of the two ledger accounts I need for this transaction? Lovely. This is great, guys. Well done. We definitely need a bank account because that's where the money's going into. And Andrew has placed £2,000 into his business bank account. Where's it coming from? Well, you're all telling me it's capital. And you'd all be right. Well done. Perfect. So now you have, see, Donna's a one step ahead of me. You already knew what I was going to ask there. What accounts do we debit and what accounts do we credit? Yeah. Where do we debit? Where do we credit? And remember, think of those scales. I've got to have a perfectly aligned scales. Excellent. This is really good, guys. And you're saying to me it's debit the bank and credit capital. And of course, you're all completely right. Yeah, well done. Why? Well, various ways to look at it. So let's look at them from all aspects. Capital represents the value that the owners invest in the business. Dead click said capital was a credit. The bank is an asset, and Pearls and Dead click said assets were debits. And my rule said that when I increase an asset, it's a debit. So I'm increasing the bank balance. It makes sense, it's a debit. The point I'm trying to get across, guys, it doesn't matter which of those acronyms you use or whether you use the rules table, you get to the same answer. The only thing I just want to make you aware of is the, I suppose, the narrative you use. So in the bank account, we've got a debit of 2,000, and in the capital account, we've got a credit of 2,000. When we come back to those transactions in a day, a week, a month, we will remember what that £2,000 in the bank's come from. Well, I certainly won't. I'll answer that question for you. I won't, because my memory is terrible. So what we do is we put an appropriate narrative in there. And the narrative we use is the name of the opposite entry. So in the bank account, I will put the name of the account where the credit sits. And in the capital account, I'll put the name of the account where the debit sits. Just so that in a day's time, for me, because my memory is that bad, or a week's time or a month's time, I can come back to that bank account and capital account, and I can see exactly where those funds came to and went to. Let's have a look at the next transaction then. So Bradley Enterprises has purchased sweets, chocolates, crisps and soft drinks for £135 from his wholesaler. We're not told that it's credit, so we're going to assume it's all cash, a cash transaction. We're going to assume the purchase, this looks to me like it's a, I don't know, perhaps a news agent or a little shop somewhere. What are the names of the two accounts I need? I need two accounts, but what two accounts do I need? What two accounts do I need, guys? And again, please don't worry if you're not sure. It doesn't matter. That's what the sessions are here for. They're here to help. Perfect. We definitely do. We definitely need a bank account. And we definitely need a bank account. Yeah, bank cash. Yeah, I haven't specified, have I, whether it was a cash, a physical notes and coins cash purchase. Well done. And I've still got that £2,000 in my bank because that was my capital investment. And somebody's already answered this question for me, so thank you ever so much. For those of you that didn't spot it, any ideas which way around the debits and credits go, though? Which one am I debiting and which one am I crediting? Again, guys, please don't worry if you get it wrong. It really doesn't matter. Lovely. Spot on. Excellent, guys. Yeah. And let's again talk through why those transactions are that way around. I mean, you've all got it right. So you clearly know your stuff. We're going to debit purchases and we're going to credit the bank. Pearls told us purchases was a debit. So that's why we've done it. We're reducing the bank because money is being paid out and therefore credit goes through the bank. And the idea with this, guys, is that at the end of a period, we can balance off our bank account and we can work out how much at that point in time we think we have in the bank. And one of the sessions we're actually running looks at how we balance off T accounts, how we balance off ledger accounts. Again, the names that we use are the name of the opposite account. So in the purchases account, I'm going to put bank because that's where the credit's sitting. And in the bank account, I'm going to put purchases because that's where the debit's sitting. Nice and straightforward. Next one. We've made some sales of newspapers amounting to £65. That word cash, guys, doesn't necessarily mean, as I said, notes and coins. It just means it was an instant sale. There was no future obligation there. Fabulous. Oh, guys, this is amazing. Well done. This bank account keeps appearing, doesn't it? Yeah, and we've got our capital in there, we've got our purchases, and this time we need to record the sale. So I'm predictable, I know I am, but tell me what you think the debits and the credits are, guys. Excellent. Spot on. Again, it's important that we understand why, and you've all got it right, but let's understand why things are debits and why things are credits. We debit the bank because according to Pearls and Dead Click, bank is an asset and we're increasing that asset. Sales is going to generate me a revenue, an income, and according to both Pearls and Dead Click, revenue, incomes are credits. Again, the name of the opposite account is used. So I'm going to, in my bank account, use a narrative of sales, in my sales account, a narrative of bank. And it just makes it so much easier, guys. So I know where I'm going. I know where these transactions have come from when I come back and look at this at a particular point in time. A fourth transaction was the payment of an expense. So you know what I'm going to ask. What's the 2 accounts I need? What's the 2 accounts that Bradley Enterprises needs here? Perfect. Excellent, guys. Definitely the bank. The bank's really busy. It's always there, isn't it? It's been there through all of the transactions we've done. But absolutely, we need an expense account. And when you're starting off, guys, there's a temptation, let's just put everything in one expense. But your business will hopefully grow. So we'll have a separate expense account for each of our expenses. So in this question, we'll have a rates account and we'll have a bank account. And some of you just are clearly knowing me too well. You know what I'm going to ask you next because you've answered it for me. You certainly will. You'll debit the expense account because Pearls and Dead Click tells us to. And I will credit the bank account because I'm reducing the asset of bank. Well done. And again, I'm going to use the name of the opposite account. So in my rates account, I'll have bank. And in my bank account, I'll have rates. The narrative becomes more important as the accounts get busier and busier because you need to have confidence and you need to be able to trace where these transactions have come from. It helps with so much of your planning as a business. You know, later on in your studies, guys, you'll look at cash flow forecast, you look at the timing of payments. The bank account is really critical in all of that. You look at making sure that as a business, you're a solvent business, you can pay your debts. The bank account is key to that. So I can't impress upon you enough. Might seem a little bit mundane at the moment, but this is really important because this information is used to make decisions further down the line. And the last transaction Bradley did is he made some more sales. So cash sales of chocolates and sweets, £150. Again, 2 accounts, guys. What are they? Absolutely. Spot on. I need a bank account. Well, you'd expect nothing less, wouldn't you? And I need a sales account. I'm going to debit the bank and I'm going to credit sales. Okay. And you know me too well because you've already predicted that next question. So thank you. And again, in the bank account, I'll have a narrative of sales, and in the sales account, I'll have a narrative of bank. So that actually seemed, guys, quite easy. And all those transactions have taken place in the general ledger. Now, I've had people say in the past when I've done this, yeah, I'm okay when we do it together. But when we go away and I'm left to my own devices, it's then when I struggle. But all we've done, guys, at all of the stages is we've just broke the question down. We've just talked the question through. We've talked about it in terms of expenses. We've talked about it in terms of income. We've talked about it in terms of assets. We've talked about it in terms of increasing, reducing balances. So if you find that when you sit down and you're doing a set of questions, you feel a bit lost, just go back to basics. Just see what the 2 impacts of the transactions are. And of course, guys, we're here to help. So any questions you have, well, please don't hesitate. Up until now, we've dealt with everything on a cash basis, and that makes life so much easier because at every point the bank's been involved. Money in, money out. So 50% of our double entry has kind of been taken care of for us. But businesses don't tend to trade with each other on cash terms. They tend to trade with the public on cash terms, but when they trade with each other, that tends to be on credit terms. And that can make things a little bit more complicated. Nevertheless, we still have to record those transactions into the financial records of the business. So we need to think about what we're doing here. Now, earlier tonight, I did say that I wouldn't apologise for the number of times I made this statement. And the reason for that, guys, is because it's important. So when we trade on credit, we're talking about when we buy now, but we pay later. Or when we sell on credit, we'll sell now and we'll collect from our receivables in 30 days' time or so. When we talk about a cash transaction, guys, I'm not talking about physical notes and coins. So I'm going to go to Sainsbury's tonight and get some petrol and I'll pay on my debit card. That's a cash transaction because there is no future obligation between me and that company. Okay, so whenever we talk about a cash transaction, it's not necessarily notes and coins. It can be a bank transfer, it could be even a credit card, it could be a debit card. It just means it's there and then. What happens though when we make a credit purchase or a credit sale? Because it makes things slightly more, I suppose, complicated because we don't have a bank to deal with. So when a business purchases goods for resale on credit, when it makes a purchase, but it hasn't got to pay instantly, it creates a payable. Now, a payable, guys, a payable is a credit supplier. It's a fancy way of saying a credit supplier. Historically, if you're doing any reading and your textbooks are a little bit older or you're doing some research, you may hear that referred to as a creditor, but it just means the same thing. We're recording the fact that the business owes their credit supplier their payable. So we won't have a bank account, but we will have an account that captures the liability we have to our payable. And equally so, when we sell on credit, a business creates a receivable, and a receivable is just another way of saying a credit customer. And if you're doing any reading historically, then a credit customer sometimes was previously referred to as a debtor. Okay, so again, there's no immediate exchange of funds. We sell our goods, we'll collect our funds 30 days' time, depending upon their credit score. And that will create a receivable. And a receivable we treat, as we saw earlier tonight, as an asset. Okay, so no bank account, but we will have an account that captures the asset being the receivable. So back to Bradley Enterprises. He's now going to start trading on credit with both payables and receivables. And the following transactions need to be recognised. Now, what I will stress to you guys is in this example, I'm only going to deal with the general ledger. But for those of you that have progressed further in your studies, you will understand that there is a general ledger, a receivables ledger, and a payables ledger. Okay, for now, for tonight's purpose, we're only going to deal with the general ledger activities. Okay, if anyone needs any further clarification on that, again, my information is at the end. Please don't hesitate to drop me a message. But we're just dealing with the general ledger tonight. So Bradley Enterprises has made some credit purchases of £150 plus VAT, and he sold some goods for £360, but including VAT. Please be careful, guys, when it comes to the plus VAT and the including VAT, because the questions like to switch just to confuse us, just to try and trip us up. So just be careful when it comes to plus and including, because the maths is slightly different and obviously the result will be different. So all we've got to do, here I am again, all we've got to do is record that in the general ledger of Bradley Enterprises. Let's do our purchase first. So we purchased goods on credit for £150 plus VAT. So I bought my bank account up because surely I need a bank account Guys, do I need a bank account? I did with all my others. And you're all telling me no. And you'd all be right. I don't need a bank account, guys, because this is credit. So there's no immediate exchange of goods, of funds. Well done. What I do need is I need a purchases account, a VAT account, and a payables ledger control account. Well done. Somebody picked me there. Okay. You can see I've got that purchases of £135 already in there. Now, these are the transactions that would take place in the general ledger. There would be another entry in the individual payables account, but I'm only dealing with the general ledger this evening. So, guys, what's the VAT on this? So £150 is the goods. What's the VAT? Excellent. Well done. Perfect, guys. Thank you ever so much. Certainly is. So I need to record the fact I've acquired purchases. I know purchases were debit because of pearls. The VAT is debit because I can reclaim it. And therefore, there must be a credit into the payables ledger control account to recognise the liability. Now, earlier tonight, guys, I said that for every debit, there's an equal and opposite credit. Now, I accept here that there are 2 debits and there is only 1 credit, but mathematically, my scales are aligned, they balance. Okay, so I've debited purchases to record the fact that I've purchased goods that I intend to resell on to profit. I've debited the VAT account because I'm going to reclaim that VAT from HMRC. And I've credited the payables ledger control account because that's money that I owe. That's a liability. And of course, I have to put the names in there of the opposite accounts. Okay. We handle that really well, guys. Let's look at the sale. So Bradley Enterprises had sold goods on credit of £360, but this time it's including VAT. So be very careful because I need to strip the VAT out, and this is sometimes where things can go wrong. Guys, how much is the VAT? Excellent. Lovely. I can't fool you, can I? I can't trip you up. You've got it. Yeah, but just be careful when it does switch sometimes to plus VAT, including VAT. The questions can tend to flip it around quite quickly, and it's just to confuse you. It's just to trip you up sometimes, guys. So I've got to have a bank account, surely, because I needed a bank account for all the other transactions we did. Yeah, bank account? Yes, no? You're just too good for me. You're spot on. I definitely don't. And I don't because it's a credit transaction, so there's no immediate exchange of funds. What I will have, and some people have already acknowledged this, guys, is I will have what we call a receivables ledger control account. So I know historically that sales are a credit, and that credit will record the income that the sale has generated. The VAT will be a credit because that VAT that I collect on the sale, that £60, isn't mine. It's money I owe to HMRC. It's a liability. And the debit will go through the receivables ledger control account to record the asset, the money that my customers owe me, and that's an asset to my business. Again, I've got 2 credits, I've got 1 debit, but mathematically my debits and my credits are aligned, my double entry works. Guys, before I just conclude and wrap the session up, are you okay with that? You certainly seem to be. You seem to be spot on from the comments in there. I don't seem to see there's any issues there with you at all, but I just want to make sure there's no questions that I haven't missed. Excellent, thank you. Perfect. So, guys, whether you trade on cash, whether you trade on credit, the accuracy of what you do is of paramount importance. And what we've just done tonight is a very small insight into the world of double entry, but the principles are there. The tools are there, the strategies, the acronyms, the rule table will help. The accuracy of what we do really is key, because we're talking here about managing a business, managing that business's performance. We can't do that. We can't maintain the integrity of our data unless our knowledge of double entry is spot on. And therefore, the rules of double entry, the world of debits and credits, is something that you need to be comfortable with, you need to be confident with. And I know, at the risk of sounding a little bit cheesy, practice really does make perfect. Yeah, the more you do, the more comfortable you'll become, the more confident you are, the more with confidence gets marks. There's lots of resources available to you guys in your study manuals, in your revision kits. Your tutors are there to help. Please don't hesitate to get in touch with us. Reach out to us. It's our job to help you, to support you through this journey. I know you've all got your individual tutors, but my name's Helena, as I said, and that's my contact details. So if there's anyone that's specifically not assigned to me, but would like to have a discussion, like to raise a question about anything I've talked about this evening, please don't hesitate to get in touch. For me, guys, that is it. Thank you ever so much for joining me this evening. And more importantly than that, thank you ever so much for engaging, because it makes it so much more enjoyable when I'm talking to people and I'm not just sat here just talking. I hope you found it useful. I really do. And I hope you find the next 3 sessions really useful too. So I look forward to seeing you very soon in concluding that. Thank you ever so much. Have a great night, guys.